Well, good afternoon, everyone. Welcome to this week's Mortgage Minute. My name is Art Alvarez with Mortgage Works, where we have the answers and they're on the house. Thanks for joining us on today's show. First, I want to go over, hopefully, some good news for everyone. Rates continue to be holding in there pretty well. As you know, we talked last week about how the 10-year bond yield finally came down a bit, providing us a little bit of relief as we were starting to approach 7% mortgages again. But thankfully, that's improved. There's the rate chart right there on our website. And you can still see that we're right around the mid sixes for a conforming 30-year fixed. FHA is still hanging in there at just under 6 at 5 7/8. So generally, that's good news. We've had at least a couple of weeks at these levels. We haven't seen anything go up a whole bunch. And you can, again, look at the 10-year bond yield to see that. Today, the yield's right around 4.26. So that's what we like to see. Now you can see there on the chart a couple of days ago, it was a little bit lower. And so what happened there? Why did it kind of creep up there? End of last week, creeped up early this week, and then dropped. Well, of course, part of it was we had a short week because of the Juneteenth holiday. So Wednesday, the markets were closed. So, of course, that has no effect on things on Wednesday. But on Tuesday, we had retail sales come out. And that's really, in terms of economic data points for the week, that was probably the major one. We have a relatively light calendar this week in terms of economic data. And so the big market mover was retail sales. And that did come in lower than expected, actually. It came in at a 0.1% when it was forecast to be 0.2%. So that is what allowed us to see a little bit of improvement in that 10-year bond yield on Tuesday. And then, of course, again, Wednesday, the markets were closed. And we've had a little bit of an uptick today, but not by a great margin. In fact, today, about the only economic data point that came out, which is not actually on our slide here, was housing starts and building permits, which interestingly both came in lower than expected. So not particularly good news, since obviously what we need more than anything in the real estate markets is we need more homes built. And yet housing starts and permits were both out today and down from what was forecast. So that's a little bit disappointing. The rest of the economic data points for this week don't really happen till tomorrow. And that's the U.S. Services and Manufacturing Purchasing Manager Index. And by the way, both of those are forecast to be slightly lower than the previous month. So we'll see if that happens. If it does, I think that would be another, one of those good news, bad news. And it's bad news if it drops, but good news because in the real estate market, in the bond market right now, bad economic news is generally good for bond yields. That helps keep them down. And then the other thing that's going to come out tomorrow is U.S. Leading economic indicators, which is also forecast to be minus 0.3, lower than the 0.6, minus 0.6 in April. And then existing home sales. And they're actually forecast to drop to 4.08 million from 4.14 million in April. So if that actually happens, that's not going to be good news either, particularly for us in the mortgage business and in the real estate business. We don't want to see that happen. In fact, if it does, if that keeps trending downward, I might have to start that part-time job as a bartender this weekend, which of course is a joke. We're doing fine. So that's basically it for this week's economic data that's affected the bond markets and therefore mortgage yields. But overall, the good news is we're holding steady in that low 4.25 range. What we'd really like to see soon, hopefully, is maybe get under 4% like we were late December, right after the Christmas holiday. The one good thing about this drop in the retail sales is it's an indication that there's more support now, even since last week, that we should see a Fed rate cut in the Fed funds rate. More likely, I think, is going to be autumn. There was some talk it might happen in July, September. My guess is it's not going to happen before the election. I think it's probably more likely to happen after the election, late in the year. But we'll see. I might be wrong on that. Maybe it'll come out in September. And if it does, that'll be real interesting in terms of how it affects the elections. So with that, that's your mortgage and bond market update. And now what we're going to do is another discussion with Jeff Harrison. And what we're going to talk about today is an interesting topic: closing costs versus down payment. Why are the two different? Because there's still a lot of confusion with a lot of prospective home buyers and in terms of those two items. and what really is needed to close your escrow. So with that, I'm going to bring Jeff on, so he's going to rifle some questions at me.
Hey, this is my favorite part because I actually get, yeah, I get the rifle questions at you. And the fun part about this is we have a list of questions and you're not sure which ones I'm going to ask you. So that's pretty cool, which actually is a sign of just how deep your knowledge is about the industry for the people you serve, which is impressive. So,
Right.
and the other part about this is,
And by the way, not to interrupt, but we should point that out to the viewers. That really is true. I mean, I don't really have a good grasp of what you're going to ask me, so hopefully I hope I don't mess that up. So
I think you're going to do well. The other part about this is I think a lot of times it's allows me to step into the perspective of the home buyer and ask questions that not industry specific, but hey, as a home buyer, I want to know this kind of stuff. So
right,
hopefully that will help bridge that gap of
sure,
the industry speak and the I'm going to say the non-tech speak. So
okay,
if you're ready, here we go.
yep, go right ahead.
So I think one of the big questions that we have out here is, hey, what's the difference between closing costs and a down payment? Because most of the time we have a mindset of like, hey, I can put X number $1,000 down, or I can put X percentage down, but they're not the same, are they? What's the connection there?
No, they're not. And in fact, it's a very, very good question. We run into it all the time, in particular for people who are, haven't bought homes before, first time home buyers. And even those who have bought a home or two in their lifetime, it's still not something that everyone has a good grasp on. It's only really the folks who've bought maybe several homes in their lifetime that have a pretty good idea what the difference is. Because very often I'll be approached by someone who wants to get qualified for a mortgage, and they'll have a particular down payment amount in mind, 5% down, 10% down, 20% down. And when I start the discussion with them, one of the things I usually recognize early on is that in their mind, when they say, I want to put 10% down, and they're buying a home, or they want to buy a home for, say, 500,000. So in their mind, they're thinking, I need 50,000 to complete the purchase. Well, I end up having to be the one to deliver the news that no, that's not quite the full story. Down payment can be strictly defined as your purchase price minus your loan amount. So when you say you want to put 10% down, and again, if we're using a $500,000 purchase example, yes, the down payment is $50,000, but that's not the full story. Why? Because you're going to have closing costs. At least you are in most cases, which we can, certainly talk about that as well. And so the idea here is you have to distinguish between closing costs and what I like to call cash to close. They're two different things. Again, down payment, purchase price minus loan amount. Very straightforward. It's cut and dry. Pretty easy calculation, right? Cash to close is your down payment plus your closing costs. And your closing costs which we covered recently on this program, your closing costs can include basically two major components. What we call non-recurring costs. Those are what I call one-time fee-based charges from third parties involved in handling your transaction. Because when you apply for that loan, it's not just us as the mortgage originator involved. There's several other parties involved who are performing different functions in that process of the loan and in the purchase escrow, and they're going to have fees and they need to get paid. Appraisal, the appraisal company, the credit report company. Oftentimes, major employers charge a fee to verify your employment. There's going to be the HOA property manager. If we have to get certain condominium documents, they have a menu of fees for each of the documents that we might have to acquire for your loan transaction. And then, of course, you have escrow and title fees. So all of those are what we call one-time, non-recurring closing costs. Again, specific fees charged by third parties that are handling a different part of your loan process. Then you have a whole nother section of costs, which we call prepaid or recurring costs. Those are a little more straightforward. Prepaid interest on your mortgage, and then prorated. Well, first year homeowners insurance plus a proration of that annual amount if you're setting up an impound account for insurance, and then of course property taxes. You may have to pay a certain portion of the annual property taxes at close, and then if you're wanting to set up an impound account, you end up having to provide some number of months of that annual property tax amount at closing to set up the account. So therefore, when you say I want to put 10% down on a $500,000 house, it's not just 50 grand that you need. you're going to need probably more like 55 to 60 to actually have all the money you need to complete the transaction. And if it is closer to the 60, I also try to remind folks, don't think that that means it's costing you 10 grand just to get the loan. Half of that number, if it's 60 and the down payment is 50, half of that $10,000 number is likely going to be not charges from third parties at all, but again, those recurring costs for prorated interest, your homeowner's insurance, and your property taxes. And that can be sometimes as much or more than your non-recurring costs. Something I always stress to people all the time, because I don't want them thinking that they contact me to arrange the loan, that because I'm arranging the loan, somehow we're charging $10,000 in closing costs. It doesn't work that way.
Well, that does bring up the question of like, okay, so with all these fees, it sounds like they're pretty fixed, or are any of these negotiable when it comes to closing costs?
Well, yes and no. First of all, I would argue that when it comes to the recurring costs, again, the first year homeowners insurance, of course, you're going to shop around for that. So you're going to, that's really up to the borrower, the buyer, to shop around and get their best deal. We try to help them with that, but ultimately they pick the provider. So they're in control of what that cost is going to be. Property taxes are property taxes. Obviously, you could call the county tax collector's office and negotiate, but that ain't going to work, right? We all know that. So that part, and again, those are major parts of your closing costs. So that section, that recurring costs, I would say, generally speaking, other than a little bit with homeowners insurance, not really negotiable. Then when you get on the non-recurring costs, the ones I described that are third-party fee-based costs for different services provided, well, really, even most of those are not that negotiable. For example, credit report. We order a credit report from a company that has a fee for it. Yeah. You're not going to be able to, I can't call the credit report company and say, hey, Mr. Smith doesn't like that we're going to, pull his report and it's going to cost him $82. He wants to pay $50. No, not going to happen. Same with the appraisal. The appraisal fee is the appraisal fee. There's a schedule that appraisal management companies publish, and they pretty much adhere to that. You're not going to negotiate that. Again, that third-party verification of employment fee that many major companies use. It is what it is, and they're expensive. $150 for one form to verify somebody's employment is really kind of crazy. Now, escrow and title fees is an interesting component of closing costs and the question of negotiability. I would argue those are not that negotiable. For one, what happens is when you're in purchasing a home, it's ultimately the agents and usually the listing side, the selling side, who are going to probably control who the escrow and title providers are going to be. Sometimes a buyer's agent and buyer may request in their offer that they want to use a particular escrow company or title company, maybe because they think they're going to charge lower fees. But in most cases, that gets negotiated away, and it's the selling side that decides who's going to provide those services, escrow and title. Can you negotiate those? Maybe. What's interesting about the mortgage process is escrow and title companies generally are insulated from even being approached about their fees. In other words, they've already been picked by the time escrow opens, and we actually are in a position as the loan originator. When we set up this file and we register it with the lender, one of the things we have to do is we have to provide estimates of all these fees I'm talking about, even though most of them are not ours. I have, now I have a good handle on what the appraisal fee and the credit report fee is going to be, of course, because, we know what those fee schedules are. But when it comes to escrow and title, usually when we start a new transaction, we maybe don't even know who the escrow and title company are going to be, or we have just found out, and yet because of the timeline that's been started with the opening of escrow, we can't wait around for a day or two or three for the escrow office to send us their schedule of fees. We have to estimate them on their behalf when we register the file with the lender. And so what happens in doing that is we and even the lender will set up those estimates higher than probably the actual on purpose to avoid under disclosure. And again, once you open escrow, can the borrower, the buyer, go to that escrow company now that they know who it is and say, hey, I don't like your fees. Can you drop them? Go ahead, give it a try. I haven't seen that be successful very often. So really, when it comes to negotiating fees, I would say that's a pretty narrow opportunity, and it's mostly going to be related to who your originator is. In other words, what you may be able to negotiate to a limited degree is the rate being offered to you, and if the mortgage originator has any miscellaneous fees, sometimes called junk fees. Folks like us, a mortgage broker, there's brokers out there who, when they deliver a loan to a lender, that lender is going to have a flat fee. Usually it's called an underwriting fee or an admin fee, and it's usually plus or minus $1,000. But some brokers will have miscellaneous fees like processing fee and document fee, and even they'll have an underwriting fee. Can you negotiate those? Possibly. But that's about the only segment of all these costs I'm describing where you really have a genuine a chance to negotiate anything. So,
Art, so we're talking about the fact that, hey, these fees are originated and estimated by you when you open that loan process up, correct?
right.
Okay.
I mean, we have to do that in order to basically get the file registered with the lender. We have to estimate those fees, and there's fee tolerances, regulatory requirements where for all these fees that will ultimately be disclosed to the borrower by the lender, we have to be relatively accurate. Like with some of them, there's a 10% tolerance. With some of them, there's zero tolerance. So we have to be very careful. And that's why when a loan is registered with the lender, most lenders, when they send out their LE, which is an acronym for loan estimate, they will usually use a fee template where they overstate the fees on purpose to keep the regulators away and avoid under disclosure, because there's sometimes significant penalties for under disclosing fees.
Well, my question is this: let's face it, buying a home is a time where there's excitement, there's nervousness, there's a little bit of stress, and when you sit down with somebody, let's be honest, there's a stack of documents that you probably have to go through with them, just disclosing this, right?
Correct.
And so my question is, again, going back to that thing of, I'll use your example, buying a $500,000 home, putting 10% down. They're thinking, I just need $50,000. And you disclose to them these fees. How often do they just kind of, because their mind is glazed over with so many things going on, they miss that? And then the day comes when they close and it's a big surprise.
Well, it shouldn't be for a couple of reasons. Number one, at least as it relates to us, and what I do, and I've done this my whole career because it's something I've observed early on, isn't actually done that often with the mortgage originator and their borrower. Even before we start the process, even before they've gotten an offer accepted, if they've come to me to be pre-qualified, one of the things I will do as part of that process is right up front, I'm going to give them a detailed itemized worksheet. We call it a worksheet because it's not a regulatory form, which is what an LE is. A worksheet is provided before we've actually initiated the loan process. In fact, right at the top, it says, this is not a loan estimate. Check with your lender to get the real loan estimate. So I've always thought what's weird about the mortgage industry is I encounter people very often who have started the process with another lender or got a quote from another lender, maybe verbally, but I'll usually always ask them, did you ever get anything in writing on this quote? Well, no. Well, what's so odd is you're about to make what I would consider basically a major purchase, if you will. Yeah, getting a loan is like a major purchase. Why in the heck would you not know upfront the actual cost, the price? And so even before somebody applies, formally applies with me for a mortgage, when on that initial call, when we first talk about what they're trying to do, I'm going to get some basic information from them. What is the price of the home you're interested in? What is your planned down payment? Do you have any idea what your credit score is? What type of property is it? Single family home, a planned unit development, or a condo? So I get that kind of basic information. And then with that, it's sufficient for me to give them a specific written itemized quote with interest rate, closing costs, the whole picture. So at that point, even before I've initiated the application and registered their file with the lender, I've given them all the information, all the numbers up front. And then I do that in part for a reason, to make sure they're okay with what I'm going to quote them. I don't want them to apply with me and then they decide I'm not giving them a good enough deal and they start shopping around. They go somewhere else because they get tempted by a quote that oftentimes, frankly, is verbal. They don't even get a written quote from somebody else, even though I've given them one. And then I want to avoid that and make sure, okay, look, here's what I'm going to charge, or here's what it's going to cost. I mean, I don't control all these fees, by the way, but the part of it, of this quote that I'm controlling, I'll tell them what part of that is. And then it's a function of they know upfront what they're going to get from us before they apply. I think that's important to do before they take that next step and submit their application. I want them to have the full price upfront, basically.
Well, it sounds like Mortgage Works, and you specifically, because you are Mortgage Works and you've been doing it for over 4 decades. You take a different approach. It doesn't sound like, from what you're saying, with people who have maybe gone to another lender, that's not the normal MO, is it?
Well, it's not as common what I do as you would think. Again, I've encountered many people who maybe at least investigated getting a loan from another mortgage originator, whether it's a broker or a mortgage banking company or even a bank. And a fair amount of times they'll say, "Yeah, I got a quote." Well, did you get it in writing? Well, no, it was just a verbal conversation. And well, why don't you get it in writing? Well, I checked, and they said, well, I need to submit an application first. And then I was told I would get a loan estimate within 3 days, because from a regulatory perspective, a lender is allowed 3 business days after application to give the borrower a loan estimate. Well, think about it. It's like you're making a purchase decision, again, getting a loan, I call it a purchase decision, with a specific lender, and yet that lender is allowed 3 days before telling you what their services are going to cost. That doesn't make any sense to me. Never has. So I want to tell you right up front, here's all the numbers. Here's what I can do based on these parameters you told me. So what I'm giving you now is subject to change if any of these parameters you told me are not accurate. But otherwise, if they are, this is going to be a pretty darn accurate indication of what we can do for you. And I think it's important to do that right up front before they even apply.
I think that's great. One of the things I also want to know is, like, a lot of times we can guesstimate, what something is going to cost us. Is there a way, if I'm, my wife and I are out there, or somebody's watching a show and they're out there looking at a home, can they use a formula to kind of figure out, hey, how much are my closing costs? So if I said I'm going to put $50,000 down, I really say I'm going to put $40,000 down because I need another 10 grand for a closing cost. Is there a formula that you have?
Well, it's tricky. In fact, we covered that not too long ago on this show, because I had talked about an article that I saw where the writer had said, "Oh, closing costs are generally going to be 2 to 5% of your purchase price." I think that's not a good approach. I mean, for example, 5%, $500,000 purchase price, 5% is $25,000. You really think it's going to cost you $25,000 to get a loan on a $500,000 home? No. And not unless you're paying a whole bunch of points, which almost never happens, or at least it's not advisable for the buyer to do that, or the borrower, because time value money. It makes no sense to pay that much money up front for a lower rate. You're probably not going to keep for that many years anyway, just to recapture the cost of those extra points. So a lazy percentage amount of closing costs, I think, is just that. It's too lazy. So really, what you want, and then the other part of the problem with using a percentage estimate is that can vary significantly depending on your loan size. If you're buying a $500,000 home and you only need a $150,000 mortgage, the closing costs as a percentage of your mortgage amount are going to be higher. Why? Because several of those fees, those costs, are fixed in nature. They're not related to your loan amount. So again, appraisal on generally about $600. Well, $600 as to $150,000 loan amount is a lot different than $600 on a $450,000 loan amount in terms of a percentage. So what I usually tell people is that for most, if you just consider what the median price is in your market, let's say it's 600,000, I would say on average, the dollar amount of your non-recurring closing costs will probably be somewhere in the range of, I would say, 5,000 to 6,500. Don't leave out the recurring costs, prepaid, the prorated interest, taxes, and insurance. That's a whole different issue. But in terms of non-recurring costs, $600,000 median price level, you're probably looking at somewhere between 5,000 to 6,500. And what's most important is realize most of that, in most cases, is not coming from us. It's not coming from the originator. On the non-recurring closing costs part of the total, at least half or more is usually coming from escrow and title, as well as appraisal. Not to point the fingers at them. I mean, they perform real services. They got to get paid. But there's a basic perception that that 5, 6 grand, 6,500 all coming from us. We're delivering that message, what the totals are, but a good portion, in most cases, at least half or more, they're not our charges. We're just delivering those estimates for you on behalf of them.
My last question, Art, and we see it all the time, and it's one of those things. Is it true or is it not true? It says, "Hey, this is a no closing cost loan. It doesn't cost no closing costs involved." What's that all about? I mean, is that now after what you tell me? Hey, these are fixed costs. You got to have them. Where do they go?
Well, yeah, that's a very good question. And no, to call it a no closing cost loan is misleading at a minimum. And in fact, you don't hear it too much anymore because rates are up. But many people out there viewing this show, you may have heard it too, Jeff, heard the ads on the radio. I can think of one particular company that for years has been well known for advertising primarily refis, and where they would offer, a no closing cost loan, not one dime out of your pocket, the greatest thing in the history of the world. And it's misleading. Why? Because all they're doing, all those fixed costs I described, all those non-recurring costs are still getting charged. But what they're doing is they're basically, it's a marketing ploy. What they're doing is they're saying, you're not going to have to pay any fees at all. But what they're not really emphasizing is the way that's happening is all those fees are being financed into your rate that they're offering. For example, on our website, you saw there are conforming 30-year fixes at 6.5, based on certain parameters. Well, if we're offering you 6.5 with no points, but we have this set of non-recurring third-party fees that I just described, that's one way, to approach it. But what if you say, hey, that $5,000 in non-recurring fees on that $500,000 purchase price, I don't want to pay those. How can I avoid them? Well, we'll take your 6.5 rate and we're going to raise it to it'll probably take to 6 7/8, maybe 7. What does that do? Because 6.5 is the current 0-point rate that we can offer. If we deliver the loan to that lender at not 6.5, but 6 7/8, what that does is it creates what's called a net lender premium. In other words, at that higher rate, we're paid by the lender. So out of the rate is how we're paid. And for 0 points at 6.5, what that means is we're getting paid by the lender. And after getting us paid, we can still offer that borrower 6.5 with no points to them. But if they don't want to pay those non-recurring costs for $5,000, we just raise that rate further to 6.5. We're still being paid out of the rate by the lender, but that extra 3/8 in rate creates a net lender premium that can be pretty substantial. And in this example, I'm suggesting it could be as much as $5,000. So then what happens is that $5,000 of net lender premium, that's essentially owned by the borrower. So on the closing, those fees are still going to be listed there, but then there's going to be this net lender credit that'll be applied to that. So that essentially, voila, no closing costs. No, there are closing costs. You're choosing a rate above market intentionally to create that net lender premium to pay those costs for you. So that's really how the no closing cost loan works. And I'm not saying it's a bad idea. In some cases, it could be a good idea, particularly if you think maybe you're not going to keep the loan that long and you can still qualify at that higher rate. That can be a good option. And whenever I talk to somebody who's sort of sensitive to costs and they want to avoid them and do this no cost approach, that's what I explain to them is like, okay, you don't like the set of costs at 6.5, no points. Let's raise it to 6 7/8, and you'll get enough money from the lender, pay them for you. You're done.
Well, that makes it, I think clears it up a lot, and understand how, some of these, almost every fee you said is a fixed cost, and it's really not negotiable. So I hope this has shed some light on closing costs and down payment. And they truly are from the same family, but they're different. They're siblings. They're not the same. Right. And so if anybody wanted to get a hold of you for more information and say, hey, I would like to get qualified and get an idea of, hey, what are my closing costs if I put X number of dollars down? What's the best number for them to get a hold of you, Art?
Well, we just moved recently, Jeff. So we have a new number. That number at our office here is 760-969-5023. Again, 760-969-5023. Or, of course, there's always my cell, which these days everyone's tends to call on cell phones anyway, 714-612-9035. So yeah, give me a call. Let me know how much money you have to work with, and I can put these worksheets together just based on a conversation. And that way you've got basically my price, what terms I can offer you based on certain parameters, and give that to you right up front, even before you apply. So you're comfortable that what we're going to be providing for you is going to come at a fair price.
Art, thank you very much. I appreciate you being on the hot seat today and filling out the questionnaire. And I think you did a great job. As I say, you've got a depth of knowledge that I could have thrown all kinds of things at you, and you'd have had the right answer. So I really appreciate it, because there's a saying you have. What is it about questions and answers?
We have the answers, and they're on the house.
Fantastic. Have a great show.
All right. Thanks, Jeff. All right, everyone, let's go into our closing question from last week to finish up our program today. As you may recall, we had a kind of an interesting one that maybe a lot of folks don't think about, at least not initially when they apply for a mortgage. Here's the question. When we applied for our last mortgage, why did we have to provide proof of the terms of withdrawal for a retirement account when we weren't using it for our closing funds? That's a good question. I've actually encountered a deal here that we're working on now where this was a condition on their underwriting approval. And my borrower actually called this weird. He thought it was a weird request. So why is this often requested of a borrower when they're getting a mortgage? Well, it's all about a concept that you may not have a lot of familiarity with, and that is post-closing reserves. Well, what the heck is that? Well, when you apply for a mortgage, with a lot of mortgage programs, you have to demonstrate not just that you have enough money for your down payment and your closing costs, which of course, if you've been through the mortgage process, we go through that extensively and document pretty much every last dollar you have to cover, again, down payment and closing costs. But with a lot of programs, in particular jumbo programs, you also have to demonstrate that you have an adequate amount of money left over for post-closing reserves. What that means is, what the lender wants to see is that after you've provided that money for down payment and closing costs, and we've verified it 6 ways to Sunday, that when you close escrow, you're still going to have a decent amount of money left over from various sources: checking, savings, stock, mutual fund, and retirement accounts. And then depending on the loan program, the amount of post-closing reserves may have to be a multiple of your projected housing expense for your loan. Housing expense, of course, is principal, interest, taxes, insurance, and HOA dues if applicable, not to mention if it's on lease land, the land lease, monthly payment, and so forth. So the idea is your post-closing reserves may even have to be a multiple of that monthly housing expense. And when you get into certain programs like jumbos, that could be a hefty amount of reserves, like 6 months reserves, 12 months reserves, even 18 months reserves. And if you're in your application, you're going to be relying on some of your retirement accounts to meet that requirement, then you have to take a further step. First of all, what is included as an acceptable source of reserves? The amount that you have vested in a retirement savings account. That can be used for post-closing reserves. Now, in most cases, that money is invested in the market, so they'll take a haircut, maybe 30% or 40% off of that to take into account market changes if it's invested in stocks and bonds and mutual funds. Plus the fact that if you're not of retirement age, part of the reason I'm taking that haircut is you might be incurring a penalty, like a 10% penalty, because you're withdrawing the money before you're of retirement age. Now, in some cases, there's certain types of funds that are not acceptable as a source of reserves. And one of those, as you can see here, funds that cannot be withdrawn under circumstances other than the account owner's retirement, employment, termination, or death. A good example here in California of the type of retirement account that meets that definition and therefore is not acceptable as post-closing reserves is the CalPERS type of retirement account. If you work as a teacher, work in the public education system, you'll likely have a CalPERS account. Those are very restrictive as to how you can access money if you run into a financial emergency. And that's the whole point here. Post-closing reserves need to be available if you have a financial emergency so that you can continue to make your monthly mortgage payment. Now, if you don't have a retirement account, you just have a standard IRA. Well, with IRAs, almost always you can take a hardship withdrawal. So the whole point of this is the lender is going to ask for the terms of withdrawal to make sure that that retirement account that they're going to use as part of meeting that post-closing retirement account, or I'm sorry, the post-closing reserve amount that's required for your loan program you applied for. They want to make sure that you can actually tap into that if you have to, rather than being prevented to from doing so if it was, say, a CalPERS account. Now, keep in mind, though, too, that if you go through the process of providing those terms of withdrawal, that doesn't mean you have to actually withdraw the money when you close the loan to meet the reserve requirement. That's not what the lender is looking for. And of course, this comes from Fannie Mae. You're not going to be required to liquidate the account or pull the money out. You just have to prove that you would have that ability in a financial emergency situation so that you'll continue to make your mortgage payment. So that's the reason for those questions when you're getting your loan approved. In the particular case I just talked about, they were having trouble finding the terms of withdrawal, and we decided that they had enough money in other accounts, and we just asked the lender to back out that retirement account from the application entirely. They had enough other money to meet the post-closing reserve requirement, so that did away with the requirement to provide those terms of withdrawal at all. Now, if it's a 401k or IRA, I always tell people the easiest thing to do, contact the administrator of the account. IRAs or a 401k, for example, almost always has an administrator. Contact them, tell them you need the terms of withdrawal. They should be able to provide that to you pretty much right away. So good question. Hopefully that explains the mystery behind why the heck do you have to provide terms of withdrawal on a retirement account. Hopefully this gives you a better understanding of why that is and how it works. So with that, we'll go ahead and go into our closing question for next week to finish up the program. And here it is. And this is something I actually had a conversation about with a prospective new borrower just the other day. And here it is. I understand that the line of credit option in a reverse mortgage allows for the line of credit to grow over time. How is the rate of growth determined? So that's the question that we'll be covering at next week's program. So keep that in mind, and I'll provide you the answer next week, and it'll be on the house. So that's it for the program. Thank you for watching and listening to this week's Mortgage Minute. Stay tuned next week when we'll have another version of the Mortgage Minute. In the meantime, stay cool out there. We're going to have a hot week next week. Hopefully out here in the Palm Springs area, we'll avoid the 1 teens. So in the meantime, have a good weekend. See you next week. So long. Take care.